Hi everyone, thanks for tuning in to my channel, All Things Accounting. Today what we're going to be dealing with is earnings per share. So stay right there and we'll go through this together. Earnings per share. What is earnings per share? Basically, it's a unit of ownership for a company. So if I go out and I purchase a piece of the company, if the company does well, then I reap the benefits of that. If it does not do well, then also I reap the consequences of that as well, because I am a one-piece owner if I purchase one share. So let's examine this a little closer. So again, it's the earnings per share. Basic earnings per share is what we're going to be computing. So earnings per share is the amount of income earned by each share of a company's outstanding common share. So the basic earnings per share formula, earnings per share is equal to net income less preferred dividends. Preferred dividends all over the weighted average outstanding common shares. Again, it's weighted average outstanding common shares. I'll show you why it's weighted average. Now, the preferred dividends, the preferred shareholders have more weight than the common shareholders. If the organization tends to liquidate and it closes up, then preferred dividend holders or preferred shareholders would get paid out before the common shareholders. So here, if it's declared during the year, the preferred dividends, if it's declared during the year, or if it's cumulative dividends as well, then you would be subtracting that. Okay, so the earnings per share figure is reported on the income statement, and it's useful because, again, it reports a company's income in terms of a single share. Now, let's say, for example, that ABC company, their earnings per share, let's say that they have net income. We'll pick out an amount of $750,000. Let's say, for example, that their common shares, as per their owner's equity statement, there's about 500,000 shares outstanding. So that would give us a value of $1.50 per common share. Remember, this is dollars here. $750,000 divided by 500,000 common shares outstanding. It will be equal to $1.50 per common share. So this is a fairly easy example, but let's throw a little twist in it. What would happen if there were shares that were sold or purchased during the year? So then that would basically change the denominator here. Okay, so we're going to examine how is that going to change the denominator. So the earnings power of common share or of an investment in a company is going to be stronger the longer that you leave the money inside the organization. Let's say, for example, in a bank account, if we have a bank account, and let's say that on January 1st of 2021, we invested $100 at a rate of 12%. So if we invested that, then that would give us at the end of the year $12. Let's say, for example, we instead invested on December 1st, 2021, and we invested the same amount at 12%. Well, it's not a full year. So let's say that would give us $100 multiplied by 0.12 multiplied by 1 month out of the whole year. That would give us only $1. So here, this is just a simplistic example of where the longer you leave money in an organization, assuming that it's doing well as well, for common shares. But a simplistic example, the longer you leave money in an organization, the more earnings, investment potential, and investment power it has to grow with. So let's look at a different example, a little more complicated. Let's set up the scenario. Let's say that if 50,000 preferred shares are outstanding and are at $5 cumulative, that's one fact. Let's say if net income is equal to $880,000. So let's say on January 1st of 2021, let's say that there are 500,000 shares outstanding. Let's also say that on April 1st, 2021, that we purchased an additional 40,000 common shares. And then on November 1st, 2021, let's say that 30,000 common shares were repurchased by the company and retired. So let's calculate what the effect of all this would be. First, if we were to take into account, remember that just over here, earnings per share is equal to net income less preferred dividends all over the weighted average common shares outstanding. This preferred dividends here, we have to calculate it. Remember, it's preferred dividends that are declared or are cumulative. It's $5 cumulative, therefore it's 50,000 multiplied by $5. That would give us a total of $250,000 that we would have to subtract from net income in the numerator. Now, we have to calculate what the weighted average is here. So let's say throughout the year, from January to March, we have 500,000 common shares. And that's for how many months of the year? That's only 3 months, January, February, March. So multiply by 3/12, prorated there. Okay, now on April, from April to November, so that would give us 7 months. So from April to November, that would give us an additional 40,000. So what we have outstanding here is 540, because remember, on April 1st, we purchased an additional 40,000 common shares. So common shares outstanding at that time for that 7 months, multiplied by 7/12 is equal to that. And then on November, remember, the company repurchased and retired those 30,000 common shares. So November to December, it reduced it. So the outstanding common shares outstanding for these 3 months, for these 2 months here, would be 510,000 common shares. So just to check here, 3 plus 7 is 10, plus 2 is 12. So it should add up appropriately. So this would give us 125,000. This would give us 315,000. And lastly, that should give us 85,000. If we sum it all up, that should be 525,000 common shares. So this is the weighted average common shares. So let's look at, if we were to calculate the basic earnings per share, what would that yield? So basic earnings per share here, earnings per share for ABC company would be $880,000 minus the preferred dividends that were cumulative of $250,000, all over the weighted average common shares outstanding throughout the year, which is 525,000 common shares. So if we compute this, the end result would be about $1.20 per common share. So this is how you account for changes in terms of purchases and retirements of common shares throughout the year that are made by the company. That's how you calculate the weighted average there. So I hope this tutorial was useful for you and it provided some insight on how to calculate the basic earnings per share. If you found it useful, please subscribe to my channel. Remember to hit that like button and that bell notification icon so that you're always up to date on the new videos and tutorials that I'll be posting in the future. Until next time, take care.